Even though there's a pullback right now in gold, go and look at the Swissy gold chart, and I consider the Swiss franc probably one of the more semi-serious fiats. Go and look at the Swissy gold chart. We've just made some number of macro targets. There will be a slight pullback, but it's going to go higher in my view. If the debt markets are going to fail, everything that is leveraged, everything that has any form of leverage, and you'll be shocked how many things that touch it. Housing, cars, everything you buy, stores, it's going to collapse. Retail, you're going to have a right sizing of the demand curve once debt gets devalued. And this is huge. This is global depression material. That's where we're at. And at the same time, there's a search for a reserve asset that's not going to collapse like debt. It's a macro bull market for precious metals.
The world is sleepwalking into a financial catastrophe of historic proportions. While central banks pretend to steer the ship, global debt markets are breaking apart beneath them, and few seem to grasp the true scale of what's unfolding. According to market analyst Francis Hunt, what lies ahead is not just a recession or a correction, but a full-blown systemic rupture. A revaluation of debt markets is underway, and the consequences are seismic: collapsing bond demand, rising yields, and a complete repricing of risk across every corner of the economy. This isn't just a technical issue. It's the breakdown of the foundation on which the global financial system is built. From mortgages and car loans to corporate debt and sovereign bonds, the leverage that has inflated decades of artificial prosperity is about to implode. Hunt compares it to an earthquake of magnitude 10, yet most investors carry on with business as usual. But once the cracks spread, the shockwaves will not be contained to Wall Street. The crisis will ripple through housing markets, retail consumption, and employment, triggering a global demand collapse that spells depression, not just a slowdown. And yet, amid this gathering storm, a new trend is quietly asserting itself: a macro bull market in gold and silver. As confidence in fiat currencies and debt instruments erodes, capital is flowing toward tangible, trustless stores of value. Hunt draws attention to the gold Swiss franc chart, and Switzerland, notably, remains one of the few countries not yet fully consumed by fiscal recklessness. For seasoned investors, this isn't just a trade, it's a rotation out of paper promises and into real assets, a shift as significant as it is overdue. If you're concerned about what's coming and want to better understand how to protect your wealth, stay with us. This video breaks down Hunt's most urgent warnings and his outlook for the future of gold, silver, and the global economy. Don't forget to like, share, and subscribe for in-depth market commentary and hard-hitting financial analysis you won't find on the mainstream channels. We appreciate the support and hope you enjoy the video.
We're in a debt-based collapse. It's the foundation stone of everything that's going down. So you have a recent low print on CPI. Our basic scenario is stagflationary. And many people have come back at us and said, oh, but look, the low CPI number. And what happened during that time? We had a tariff, Trump's tariff tantrum, where essentially he stopped containers. It's almost like mini lockdown.
Yeah, they called it an embargo, actually. I think Besant even said embargo.
100%. They stopped containers, which obviously is going to affect consumption and is going to lead to those low CPI numbers. More importantly, we had the Saudis decide to increase supply, and then further, today, we see in June they intend to further surge their oil supply. So why, in a recessionary environment where goods haven't been provided, where there's a downturn in demand, we're hearing about record bankruptcies in the States, record levels of, they call it the 90-day in bad state of repair credit card, automotive, and housing, all at literally new highs. And you've got all that environment, and people are saying, yeah, you see, but the low CPI, we're not going to stagflate. So in that environment, why would the Saudis be pumping more oil? They've got to keep the inflation tax. Oil is a multiplier in inflation. It's in everything, as you're well aware. Delivery, you name it, travel, business, commercial, holidays, everything you buy, everything you do, packaging, 100%, breaking ground, whatever you do. So it is an absolute. So if they get a disproportionate supply demand, they put downward pressure on oil. We were the guys that told you a couple of times on when we've appeared on your show, long gold, short oil, because essentially we're in a consumer retail retail-based in recessionary type environment, while in that same time we're getting a debt-based collapse, referring you to my opening statement, which means we need a new reserve asset. Let's go back to the old reserve asset, aka gold. The other key point is those long-term debt percentages are going up across the board, with the possible exception of China and Switzerland. You're looking at the 10-year, the 20 years, and the 30 years all going higher on rates. What is that? Debt devaluation. That's going to kill the housing markets. This is we referred to the massive amount of rejections on refinance applications in the States, 42%, 36%. Nobody wants to originate a debt instrument asset anymore by letting people borrow. And at the same time, the existing assets on the long, which are on long debt, are actually, we've got the curve steepening and the rates are going up. So the asset is devaluing immensely. So that's what's going on. And you've then had the stop in the economy. I call it the effect of a mini lockdown. You can call it an embargo. It has a similar effect. So you get a low inflationary read. It's trying to massage the numbers. The Saudis are in cahoots. They will be compensated for doing not-for-profit selling, and they are being compensated in many, many, many ways. They're becoming the entertainment hub. Well, the Middle East, the Arab Emirates, let's not be too specific. You're getting all the football there. As I was joking with you, they don't play rugby, and they're already down for after Australia to host the next Rugby World Cup in the desert somewhere. All of these things are being crowded into that area. You had Elon moving Neuralink lab to Dubai. All of this is happening. I actually think you're seeing the tech hub that Silicon Valley once was, in part being slowly bled out. And Trump is enabling this. So everyone who thinks he's MAGA and make America great should maybe think again, because his big pals with the Saudi Arab Emirates is normalizing this society as they are seeing it as a coronation in terms of the significance of their region in the area. Well, when you say the Fed, everybody assumes that the Fed gets to determine the interest rates. And again, I refer you to literally the opening state. It's a debt-based collapse. Because for the Fed to be able to set the rates lower, you're actually saying, well, this asset is now worth more. And there's an absolute plethora of it. They've got $9 trillion to roll. They haven't. That's not including the additional expenditure that have gone. In truth, the doggy savings that you've been told about are minuscule. And if you look at it in a big time frame curve, there's no real meaningful adjustment. Not that I'm going to say if any efficiency is a bad thing and culling a lot of the bulb products, but this is nickel and diming. It's saving it's pence.
You're saving 10% or whatever it is.
Pence wise and pound foolish. The big money is the problem, and so as a result of that, he doesn't have the power to cut rates. In fact, the Fed's never been more clearly boxed in. They need actually. For the debt to be devalued, they should, on that behalf, be comfortable with raising rates. Think a Volcker upswing that was at the 80s. But in terms of the economic health of the consumer and the nation and the state of bankruptcy that I imagine many consumers are in, many municipalities are in, many states are in, they can't actually do those cuts because there's no bid on the debt. So this is all about the reserve assets that was afforded to bonds that ended with the 40-year bull market. He doesn't have the power. He's boxed in.
Francis Hunt lays out a damning diagnosis. What we are witnessing is not just cyclical pain. It is a debt-based collapse unfolding in real time. At its core, the system is failing not because of transitory shocks or central bank missteps, but because the foundational structure of modern finance, endless credit expansion, has reached terminal saturation. Even as some analysts point to softening CPI prints as evidence that inflation is fading, Hunt warns this is a dangerous illusion. The real story is one of economic paralysis dressed up as progress. Tariffs, shipping disruptions, and orchestrated oil supply maneuvers are not signs of strength, but desperation. They suppress consumption artificially, creating misleading inflation readings while concealing the structural rot beneath. The Saudi oil play is particularly revealing. In a world supposedly facing recessionary conditions, they're ramping up supply. Why? Not because the global economy is thriving, but because oil is the silent engine of the inflation tax. Every aspect of modern life, from transport and logistics to manufacturing and packaging, runs on oil. Maintaining elevated oil prices keeps consumer inflation alive, even as demand craters. It's a strategy to preserve fiscal illusions, not economic reality. Meanwhile, bankruptcies are surging. Delinquencies are spiking in credit cards and auto loans. Over 40% of refinance applications are being rejected. Consumers, businesses, and even municipalities are facing the brutal squeeze of rising interest rates on depreciating debt. And still, many investors cling to the myth that the Federal Reserve holds the levers of control. Hunt argues the opposite. The Fed is boxed in. Its supposed control over interest rates is crumbling as bond markets revolt. With no real demand for government debt, pricing becomes meaningless. You can't force the market to accept bonds no one wants, especially when they know those assets will be devalued by inflation and higher yields. The age of debt as a reliable reserve asset is ending, and when the foundation of the global monetary system, sovereign bonds, begins to unravel, what comes next isn't just a financial correction, it's a seismic realignment. This is where the rotation into precious metals begins to make sense. Gold and silver aren't just alternative assets, they are the logical endpoint in a system losing faith in fiat promises. As capital flees a crumbling debt structure and seeks shelter in stores of value that do not require counterparty trust, precious metals reassert their timeless role. What we are witnessing isn't a temporary trend, it is the beginning of a new monetary order, one where scarcity, not leverage, becomes the defining principle of wealth preservation.
So just to deal with that measure on the Swiss, it's the short end, first of all. So it's 1 and 2 years that have just dipped negative again. And that is a sign of distress. So what that means is really afraid people are prepared to guaranteed accept less money back in 1 or 2 years' time than they give you. Plus, Switzerland still has an inflation rate. It's between 1.3 and 2.2, depending on any given year. That's according to their statist exemplar of stats, which I'll never trust on any nation. But anyway, it's there or thereabouts, let's just say. Let's take them at their word. So you're going to lose the inflation rate and you're going to get less. You'll pay if you do a 2 year, you're essentially going to pay 104,000 to get 100,000 back, or you'll buy 100,000 bonds and get 94 back in 2 years' time. That's expensive, and that makes gold look cheap. You know, Buffett criticized gold for not paying a yield. No. When you're paying a negative yield, not paying a yield becomes a feature, a benefit. And that's why I'll say, even though there's a pullback right now in gold, go and look at the Swissy gold chart, and I consider the Swiss franc probably one of the more semi-serious fiats. Go and look at the Swissy gold chart. We've just made some number of macro targets. There will be a slight pullback, but it's going to go higher in my view. So history is quite binary. Your bonds or your stocks.
No.
When you risk on, you run into stocks. When you're afraid, risk off, you run into bonds. It's quite binary, and people are being traded in that. That's the 60-40 portfolio. That programming is going to take a while to unfurl. So initially, right now, that long bonds are being sold off, and everybody realizes Druckenmiller and Tudor Jones have been short and have been building a short position that they're now disclosing in November last year. They probably did it the whole year, getting their positions on. Now everybody thinks, okay, maybe we should be following suit. So the natural flow is often equities to start. But if you become really worried and you want to stay in bonds, you go to a country like Switzerland on the short end, which is what we just described. That's an illustration of stress and fear about return of capital instead of return on capital. But the smart will really say, bonds isn't the game. It's a crap product. No matter where you buy it, you're either not getting paid enough yield or your risk of default isn't fully priced in. That's why we're seeing the long ends continue to price up, because the risk of default is far more critical and likely to happen. So bonds is the worst investment anywhere you do it, in my opinion. Long, short end, any nation, stay out. And what tends to happen is, okay, where's the reserve asset? And that's why I say gold will benefit. We've seen a little bit of a better performance from crypto. It's a much smaller market cap, but there's some flows in there, and there's equities.
But that's more of a risk-on asset. Sorry to jump in.
It is a risk-on asset. Yeah, it is a risk-on asset, but it's being treated slightly differently because its time as a future waiting in the wings, waiting for the new system, is now coming. It's going to get a spotlight appearance where it has a bit of Midas feel about it. It has a messianic moment, and gold is in that same spotlight as well. well, but has already really, really run. So as gold maybe rests, I think maybe a little bit of the spot will fall on crypto. And of course, the Pavlovian response of running into equities is still there, but it's the wrong one. It's the outdated. You're coming out in your 80s fashion. You're wearing your leg warmers and going to Jane Fonda classes if you're still rushing into equities right now. That's my take. Because the PE, if you look at the market caps of the US relative to the rest of the world, my net opinion is those relative market caps are going to come chronically down in America, and you're going to see other market caps. I see indices going up in emerging markets. I see it in Singapore. I see it in other capital formation nations. America's going to lose market cap to the rest of the world in equity. So I think there'll be a geographical flow. If we're just staying in equities, there's going to be a geographical flow away from the US still, because of the tariff. You can only scare people like they did with the tariff tantrum once, and trust is eroded. They did long-term damage on trust there.
Fool me once. Right?
Yeah.
No, absolutely. Ray Dalio, $320 million Bridgewater investment into gold. What do you make of that?
Ray's consistent, actually, in fairness to him. I knock a lot of these big billionaire heroes for their lack of consistency, and I'm going to add you a Warren Buffett in there as well to your question. Ray Dalio at least is consistent, and he's buying a reserve asset, and he's very concerned about the bond reserve asset that's finished its 40-year period of being a reserve asset. So I think he's consistent. Warren Buffett is stepping down, and he's chosen this year, and he spoke the words. This is Captain America, who said you won the lottery by being born in America. This guy's never been a bigger nationalist and patriot in terms of all his financial commentary ever. And he's stepping down, and he's admitting that his successor is likely to be more internationalist, and he's expressed concerns about the state and valuation of the dollar, and he's also made comments about the trade deficit and the overall debt levels. So you're talking about a man who's signing off more pessimistically than he's ever been by a multiple of about 10 times. So for your Ray Dalio, I think he's doing exactly what he sees, and I think he's right. And Warren Buffett is no longer wants to be the guy running Berkshire and investing offshore and saying America sucks. He never wants to be that guy. Who knows? He might become very unpopular and get tax audits if he did it. He's leaving it to his successor to set a new vision and pursue a new path.
The signs are converging, quietly, relentlessly, toward a singular outcome, a global economic depression, not triggered by a sudden event, but engineered through years of financial malpractice. What Francis Hunt describes is not a crash in isolation. It's a systemic breakdown, the failure of debt as a foundation for prosperity, the erosion of trust in fiat currencies, and the slow death of the bond market as a place to hide. This depression won't look like 1929. It will be more sophisticated, more concealed, masked by manipulated data, emergency interventions, and digital distractions. But its effects will be no less devastating. Collapsing purchasing power, widespread capital destruction, and the brutal repricing of everything we once considered safe. In that environment, precious metals will not rise because they are shiny relics of the past. They will rise because they are the last assets that carry no counterparty risk. Gold will not merely perform, it will outlast. Silver, long suppressed and overlooked, will move violently when monetary velocity breaks free from central control. This isn't speculation, it's history repeating in high resolution, and the longer the system pretends it's stable, the more dramatic the correction will be when it finally unravels. So when you hear talk of gold's pullback, remember, we are shifting into a new financial era where real value, not promises, defines wealth. If this resonates with you, subscribe now. Comment below with your thoughts on the coming depression, and share this video with someone still holding faith in a system built on debt and denial. Thanks for watching, and see you in the next one.